Inflation, as measured by the Consumer Price Index, the core CPI, fell to 4% year over year. That is a significant deceleration from where we were a year ago, where we were close to an 8% core CPI. So inflation is clearly decelerated. This has been helped by a couple items. The bottlenecks around COVID have dampened. In addition to that, the stimulus checks that artificially increased demand have run their course, and that spending is starting to roll over. We also had the release of crude oil out of the Strategic Petroleum Reserve, which ended up helping reduce the price of gasoline and fuel stocks over that same time frame. So we've had multiple things to help dampen the CPI. We're now coming in at a core CPI of around 4, and the overall CPI, which includes food and energy, is coming out around 3.1% year over year. So clearly the Fed still has some work to do to get down to its 2% stated mandate. In my opinion, that mandate is going to be very difficult to get to. We're not going to have a repeat of the crude oil situation. We are not going to have a repeat of the stimulus checks going away. We are not having a repeat of the bottlenecks being dissipated. So a lot of the drivers that drove up CPI and have now reversed are now behind us. So we're looking like we're going to have a sort of a sticky number here, and 2% is a goal they continue to talk about, primarily because inflation that is unexpected helps the federal deficit. Inflation that's expected does not help the federal deficit, and the federal deficit needs a lot of help. We're currently running around a $2 trillion, $1.7 trillion deficit on an annual basis. This is piling onto our debt that's now close to $34 trillion. That does not count unfunded Social Security and Medicare liabilities, which adds about another $50 trillion to that. So we still have a lot of work to do as far as fixing the deficit, and inflation, if it's unexpected, could help with that. So they continue to talk a 2% game, but that's very unlikely. The other item that's taking place here is that the economy does seem to be slowing in parts. The strongest part of the economy last quarter was government spending, which accelerated. This is helping with increase the deficit, helping to increase the debt, but is not really a sustainable way to produce economic growth. And you could actually argue that government deficit spending is usually inefficient and does not add to the longer-term capital capacity of a country, and is very inefficient type spending, so not really strong growth, not real growth. In addition to that, we now have the moratorium on the student loan debt repayments is coming to an end, and consumers are having to start to pay back those student loans. And this goes across demographics of income. You have doctors and lawyers that have big student loans; they're going to have to start paying it back. And then you have kids with BS degrees as well, BA degrees, that you're also going to have to start paying back. So it's a wide swath, but you're beginning to see that show up in consumer spending, which is weakening, and you're also beginning to see that show up in credit card data, where delinquencies are accelerating at the fastest pace since 2008, so right before the financial crisis. So the consumer is definitely weakening here, but the economy did have a good third quarter, driven by the government spending, but the fourth quarter does look like it's going to be considerably weaker than the third quarter. And we have an area where you're really going to have to take a look at what's going on. I would stay away from banks, credit card companies. I think those are very exposed. Retailers, companies with big exposure to consumer are going to have some problems. The other area that's problematic is commercial real estate, whether that is office or retail. There is considerable excess capacity in both of those sectors, and that's also going to spill over into the banking sector, which makes loans and mortgages to those office space and retail real estate. So that area should be problematic. So I'd stay away from that whole sector. The market is actually pretty flat, with the exception of the 7 biggest stocks which have driven the return this year. And the participants in the marketplace, stock investors, have crowded into those stocks. These are great companies, like Apple and Google and Nvidia and Microsoft. These are all great companies that have very good fundamentals, but those are what have gone up this year. They've driven the valuations on some of those companies to extreme levels that it's going to be hard for investors to make great money on these over the next 5 to 10 years. They've been the place to be over the past year, but the valuations make it very difficult to produce good returns in those companies over the longer 5-year period. So the bottom line, though, is outside of the 7 stocks that have driven the market and the profitless techs, which was part of the bubble that we got to in the 2021 that has really popped. Profitless tech has actually bounced back as well a little bit. Those areas, some of those stocks are headed towards zero, so I'd still stay away from those. But if you can start to get outside of that into the other 490 companies in the S&P, the other 1,500 companies in the Russell that aren't in retail or commercial banking or real estate, you start to find some real opportunities, and it's worth taking a close look at those. So outside of the select area, there's definitely some opportunities. I hope you find this helpful. This is Ben Halliburton. This is Building Benjamins. This is what I'm doing for my own portfolio. Please remember, this is not investment advice. Take a look at our full disclosure, and you can also sign up for text and email alerts so you can get this information on a timely basis. Thank you, and have a great day.